G'day everyone and welcome back to this Share Cafe Hidden Gems webinar. Thank you for your time. We always appreciate your time. Today we're talking translation technology, crypto, financial services and silica sand. Never a dull moment. Nothing from me you'll be pleased to know in regards to the market. Don't forget to ask questions. You can type your questions in the Q&A box provided. The CEO always loves to get your feedback and get your insights, so feel free to ask some questions. We're going to start off with AI Media. Got a market cap of around 69 million. We welcome Tony Abrahams, who's the founder and CEO. The company makes captioning and translation technologies available to everyone around the world, across purposes, across industries, across platforms, and across languages. Tony, we welcome you back. Thanks for your time.
Thanks, Tim. We might move to slide 3. AI Media is a global technology company. We deliver live and recorded captioning, transcription and translation. I co-founded the business in 2003. We listed in 2020, which has provided us capital for our highly strategic $55 million acquisition of EEG in May 2021. And we might move to the next slide. I do want to spend a fair bit of time actually on this slide because this pyramid really does illustrate how complementary the EEG and AI Media legacy businesses are, and how putting these businesses together has delivered a unique and compelling proposition for our B2B customer base, which has been reflected in fantastic financial and operational results in our first full year post-acquisition, and is providing a great runway for continued global growth. The key context to understand here is the technology transformation currently underway in the speech-to-text industry. Now, until about 2018, the only way to deliver accurate live speech-to-text involved real-time human operators who would either operate a stenographic keyboard or a technique that we pioneered with someone called a re-speaker, who would actually listen to the conversation in real time and simultaneously re-speak it into a speech recognition engine uniquely trained to their voice print, which delivered accuracy far in excess of the automated systems that didn't know who was speaking. This is the AI premium product on the left of the pyramid. And we combine that with our patented AI live streaming and display technology, which is at the very top of the pyramid, so that a re-speaker could be anywhere in the world and the text would stream to any web viewer that is fully customizable for any screen or any font type. Now, although AI Premium delivers unmatched quality, it is expensive as it requires a trained human in real time who needs to be booked and scheduled. So in the background, our R&D team has been hard at work since 2017 to develop a more scalable and cost-effective solution than re-speakers. And in April of 2021, we launched our groundbreaking Smart ASR service that sits just to the right of the AI Premium service there in the middle of the captioning solutions row, and improves significantly on the out-of-the-box automatic speech recognition systems, and it's priced at about half of the rate of the AI Premium service. Now, the remainder of the pyramid, including the fully automated Lexi service, the captioning infrastructure layer, and the ICAP network infrastructure layer, those we acquired with the EEG acquisition in May of 2021. Now, the patented EEG product lines have dominated the US broadcast market since the 1980s, with the physical encoders that are there on the left of the second row of the pyramid. The genius strategic play that the EEG team made about 12 years ago was to connect each of these devices through a private and secure network infrastructure, which is at the bottom layer of that pyramid, known as ICAP. And today, ICAP really is the foundational layer of our business. We are now successfully deploying ICAP globally. As I mentioned, it had a ubiquitous position in the North American broadcast market, but almost zero presence outside of North America. What we're finding now is that the appetite for both ICAP, those captioning infrastructure solutions, as well as the captioning solutions and the delivery model, are as applicable outside of the US as inside the US, and as applicable outside of the broadcast industry. And I'll give a few case studies. The ICAP network facilitated also the development of our virtual encoder, which is in the middle of the captioning infrastructure layer there, and the cloud-based encoder known as Falcon. ICAP is also the key to future-proofing the remainder of our product suite, as it allows updates, security patches, and additional cloud services, such as improved translation, to be pushed immediately to all of our customers' devices. Putting all this together, we're in a unique position in the years ahead to benefit from what has been an explosive growth in captioning, driven by the shift from a book-to-caption model to a click-to-caption model that everyone who has been using Zoom and Teams through the pandemic has come to expect as default. And to give you a sense of scale, over 100 million meetings were captioned on Zoom in the last 6 months alone. People now expect captions on demand, and ICAP enables delivery of these captions in many more environments beyond Zoom and Teams. We'll move to the next slide. This slide shows some of the compelling customer needs that we're solving from the OTT and IP transition, supported primarily by our Alta and Lexi products. Meeting room accessibility, which involves putting in infrastructure in customer sites that mean anyone turning up in any meeting room can simply click a button and captions and translation appear there and can be streamed to personal devices. We're also looking at a partner program to take advantage of a very fragmented market in many parts of the world. And I'll talk a bit more about that. And also tailored broadcast solutions as our broadcasters increasingly deliver across multiple platforms. Slide 6 shows some of the case studies reflected in wins in FY22, which incorporate both our premium service wins with Google and the UK Parliament, and exciting SaaS and technology wins with Major League Baseball. And in fact, it was a successful transition of Sky News from the premium service to SaaS that's led the way for some even more exciting news. So if we move over to the next slide and then through to slide 8. Last week, we announced a really big win with the 5-year renewal of our exclusive contract with Seven, where we will transition network towards a SaaS model, as we have done with Sky News. This will deliver cost savings to Seven and improve margins for us. Slide 9 shows the importance to Seven of this technology transition as enabled by our EEG integration. It really is a game changer. It's allowing Seven to get more captioning on more content, but also really importantly, it's letting them access their archived content through a simple search of timed caption files. So this is a really, really strategic win and one that we've been working on for a while. I'll quickly run through the remainder of the deck as you can see this in more detail in our recent full year results webinar. Slide 11 has the key highlights of FY22, which clearly show the improvements in operating leverage. We had a 22% increase in revenue and a 63% increase in gross profit. And this was driven by the improvement in gross margin from 41% to 55% in just 1 year. And this is driven by the breakout growth of the automated products, Lexi and Smart Lexi, up 125% this year, which turned to a $9.8 million improvement in EBITDA. Next slide shows the even greater turnaround in operating cash flow, with free operating cash flow of $3.8 million for the year, excluding acquisition-related fees. Slide 13 shows more of the sales wins as we transition. On the left, these are existing ICAP customers we are now transitioning away from competitor premium services into Lexi and Smart Lexi. In the middle, these are the key wins where we are able to now offer much higher quality wraparound services for customers like the Parliament, New South Wales, UK Parliament and Google. And the right is probably one I'm most excited about. And this is where we are actually winning new customers onto both the ICAP network and the Lexi and Smart Lexi network. And part of the big transition that we're working through there, obviously, are our largest customers, 7 and 9. The next slide provides a bit more granular detail on the growth engines of ICAP and Lexi. The slide after that shows the increasing importance of our technology, SaaS and device revenue, which is at significantly higher margins than the declining services business. And again, this is the transition that we are looking to lead our customers through in the years ahead. The next slide is a really interesting one. It shows the competitive landscape. And this is from both a captioning solutions and a captioning infrastructure perspective. And what's interesting is that our traditional captioning competitors, Verbit, 3Play and Redbee, are actually our customers now because they use the EEG ICAP network to deliver their services. And this has opened the door to our strategic partnerships program on slide 17 and 18. And I might just skip in the interest of time to the final slide, slide 20, which is our 3-year roadmap to 2025, which has really got 4 key pillars. First, to establish ICAP as the global standard, not just the standard in US broadcast. Secondly, to grow and diversify that customer base. Thirdly, to increase the revenue share of SaaS and devices. And finally, to continue to enhance our product suite and technology. And with that, I'll hand over for questions.
Thank you, Tony. Bang on time. I've always been fascinated by this, by your business, and congratulations on the progress. Now, you had some bad press some time back. There was speculation that Channel 7 might terminate your contract after, I think, some newsreaders were caught discussing Novak Djokovic, of all people. They've obviously just signed a fresh 5-year deal. Can you comment on that?
Yeah, I guess the short answer is don't believe everything you read in the newspaper. But I think that, look, the longer answer is, yeah, one of our captioning operators in a work from home environment had seen that back of studio discussion that happened with those 7 newsreaders, literally held a phone up to it and then posted it online on through some various chat forums, and then lo and behold, we woke up the next morning and 800,000 people had seen it. So it was a bit of a headache. But what I can say is that these sort of things are not unanticipated. There are provisions in all of our customer contracts for how we deal with events like this when they do happen. We were able to categorically identify the culprit within 7 minutes. And I think we worked very, very closely with Channel 7 to ensure that the damage was minimised and that the appropriate actions were taken. And with that, despite all of the speculation that kind of went on for a very long time, we had a very, very strong relationship with 7 right through that. Obviously, we would never disclose anything confidential without our customers' permission. And so you kind of just have to sit there in the background while all the noise is carrying on around you and just keep your head down, bum up and push forward.
The joys of owning your own business. Can you just quickly tell us the significance of that Channel 7 contract to your revenue? There's a question here on that.
Yeah, look, they are one of our top 3 customers. As I've said, we are delivering a service to them, which is offering them significant cost savings on what they what they're paying now. But really importantly for us, we've actually migrated them from a services revenue model of sort of time and materials billing to a fixed fee per month. And that enables us to continue to improve the efficiencies of the way we deliver the service over the 5 years, and continue to add more and further benefits to 7 as we deepen and tighten the integration with them and their systems, including our sub-silo implementation, which allows them to access all of their archived news content effectively just with a text-based search.
And you've got 15 million in cash. There's some questions here around, you've got a buyback on. Why was the buyback only 2 million shares so far? You've also, there's an earn-out here where you've got to pay out about 4.5 million. That was deferred by 12 months and an 8% interest. Why aren't you just paying these out with cash?
I'll take the last question. So the earn-out was for $4.6 million for the EEG acquisition, and that was based on the absolute breakout growth. You know, that business, which was, you know, a 40-year-old business, we managed to grow at over 40% in the first year of acquisition. And the vendor, the EEG vendor, is AI Media's third largest shareholder. He has 15 million shares. Rounding it back to the first part of the question, asset prices are pretty attractive if you're a buyer at the moment. And there are some really interesting technology angles that we're looking at the moment for continuing to improve the quality of the captioning experience and the translation experience. And Phil McLaughlin, who's the EEG vendor, really wanted to make sure that we had as much of that capital available to take advantage of that over the year ahead.
And just finally, Google's a player in this space, from what I understand, and one of the leaders in speech to tech, but they've just kind of signed a 5-year or 3-year, $5 million contract with you. How is that going to play to your advantage?
Yeah, look, I think that really does illustrate the importance of having that full suite of services and solutions. So Google does a really good job of the automated captioning, which is effectively Lexi. So they're not buying Lexi from us. What they're buying from us are the premium service, where we have designed a product that is fully secure behind the Google firewall, and where we have operators who will effectively make sure that the really important meetings and that the really important events that Google have are not just fully accessible from a transcription perspective, but they're fully accessible from a translation perspective. And our translation technologies, combined with the smartness in the Smart Lexi and the premium service, is what's required for Google to ensure that their employees, remember this is for Google employees, that they have really direct access to this very high value content that's being discussed. I mean, when you think about the value of the Google engineers who may be getting together in a team of 5 across 4 continents where they speak 3 different languages, having that accurate transcript and record really does improve the effectiveness of what they're doing. Now, Google are already doing this, but what they've done is they've consolidated multiple vendors into one, and this is really the benefit of the scale that we've now got. So we're looking for more customers like that.
Thanks, Tony. That's all we have time for. There's quite a few more questions if you've got time to answer those directly. If not, I'll shoot them through to you over the weekend. Thanks for your time.
No worries. Thanks, mate.
Next up, we have Allup Silica, ASX code APS, market cap of just over 7 million, hasn't been listed for 12 months. We have with us the executive chairperson, Andrew Haythorpe. Allup Silica is focused on the future development of their silica sand tenements located across a number of exploration project locations in WA. Andrew, thanks for your time. Over to you.
Thanks very much, Tim, and it's a real pleasure to be here. If we could move on to slide 3, please. Thank you very much. So Allup Silica, we're a very new company. We only listed in May of this year. We believe we have a very unique approach to business, and we do look at this as a real business opportunity. We have a combination of projects which involve access to ports or potential access to ports as we move forwards, because silica is a bulk commodity. So we have 2 projects to the north, Argyle, up in the Kimberley region near Wyndham. Northern Territory, we've just recently applied for a tenement in the Northern Territory. And down in the south, we have the Southwest Silica Project, which is where we started about 2 years ago with our first technical work. And I'll talk more about that shortly, and Esperance over near the Esperance port. So this company is really focused on projects, purity and ports. Next slide, thanks. So let's just start off with why silica and what is silica? Well, silica sand, it's kind of everywhere. However, to get high purity silica and the ability to mine high purity silica and then the ability to export it, that's where the business opportunity really exists, and that's what our focus is. In terms of silica supply, what we're seeing around the world is new government policies being put in place. This affects other commodities as well, and they're generally called strategic commodities now. And that is that we have government policies for renewable energy, et cetera, public demand for high technology opportunity or high technology technologies. And high purity silica is an integral part or an integral commodity used in many, many technologies and many, many applications. So semiconductors, computer processors, and sort of something more visible and more relevant and interesting today is, of course, photovoltaic cells or solar panels. And on that slide, there's just a snapshot there of a solar farm. All of those panels in that farm, which goes for many, many, many hectares, has silica glass covering and protecting the cells. So that gives you a visual indication of the sort of thing happening when we talk about solar farms. There's a lot of silica required, and the demands of that is very much high purity. Next slide, thanks. At the same time, there's actually more restrictions happening on existing suppliers. So existing suppliers have simplistically two components: a building commodity sort of bulk type sand, which is used in construction industry, cement in particular, and then a smaller but focused, if you like, high purity silica sand, which is the very white sand we'll talk about through this presentation. Interestingly enough, there are trends not just for recycling certain commodities, but also including recycling cement. And there's certainly some countries in Europe now which is aiming for 100% recycling of cement with a view to minimising or eliminating completely sand mining. So, of course, as these countries reduce their sand mining, the availability and supply of that high purity silica just as a little component coming off the edge of the construction sand mining industry, that's going to drive demand and prices, we think, moving forwards. And then there's other factors, of course, come into play in terms of environmental restrictions on traditional sand mining areas across the globe. Next slide, thanks. So let's just talk a little bit about us and what we're doing in Australia. Sparkler is the project in the southwest that we started with. And we've done some initial work there I'll show shortly. Sparkler is situated next to a major highway, which actually runs through to Bunbury to the north and Albany to the east. And both ports have the capacity for 50, 60,000 tonne ships. Both are involved in exporting a variety of commodities, both agricultural and mining. And so our project there, easy trucking distance to both ports. So we see real potential in Sparkler, and we'll be drilling that again shortly. Next slide, thanks. So in terms of Sparkler, what it looks like, and this gives an indication of the business, the slide on the top right there, that's the sort of land and the land value that we're looking at, where we think the value of that land is better realised to have at least cohabitation mining project along with perhaps the agricultural application. And you can see a handful of sand literally that grabbed from that site location. And this is one of the areas, our first area, where we have a 70 million tonne JORC resource as our first resource estimate. We did that drilling because we could see high purity silica there. And when we say high purity, it's above 99.5% silica, and the potential also to reduce it below 100 parts per million iron. So stage one's complete, and we've got our initial resource estimate there, and we're going in for further drilling, as I mentioned. Next slide, thank you. So in terms of the previous work, the little orange balls there on that map is where we've drilled before, and we can see good sand thicknesses and good purity over good widths. The 17 metres at 95%, for example, the 95, 97, 96%, that's raw silica grade. So that's got other material mixed in with it because that's just how it presents in nature. I'll talk a little bit about that as well today. So very happy with that. We're planning to get in there and infill drill in and around that area shortly, and then also to drill further afield and expand that resource potential further. Next slide, thanks. Now to move across towards Esperance, which is our second project. Esperance has two ELs granted that potentially feed into it. One's Dune Buggy down to the south, and the other one's Pink Bark further up to the north. Dune Buggy, which is sort of highlighted there in the bottom picture, is a sand mass with good clean sand and a substantial tonnage potential. We've done a drone survey over that, 470 million cubic metres indicated from that drone 3D survey. So we've got metallurgical test work underway to see what we can do with that sand in terms of optimising its potential value. Next slide, thanks. And up at Pink Bark, up in the wheat belt to the north, it's 20 kilometres to the railway line and then 90 kilometres down to port at Esperance. Again, 95, 96, 97, 98% raw silica sand that we've seen at surface. And that second picture there is an auger drill hole that we've drilled. And again, you can see just visually pretty clean sand. It's sort of got that white greyish colour, which is what we're looking for on our first searching. We've had previous drilling there that indicates sand 14 metres in depth, previous drilling by other operators who are actually looking for base metals in the basement underneath the sand mass. So we think we've got real potential for a significant volume and tonnage of sand and good quality specifications here at Pink Bark. Next slide, thanks. So Cabbage Spot up near Wyndham. Wyndham Port's terrific, a lot of available capacity there, and we're just in the final stages of getting all the permits and approval and land council access to that. So we hope to be drilling that next year. Next slide, thanks. So in terms of high purity silica, on the left-hand side, you can see the raw sand, which has got that sort of, you know, when you take a photo, the greyish colour. Then on the right-hand side, you can see just with simple gravity and washing and magnetic separation, we're getting very high purity silica on the right-hand side with those pictures taken through a microscope. Next slide, thanks. So for the company moving forwards, it's very simple. Drilling, metallurgical test work, it's been underway this year and continue to do so. We've got drill-ready targets that we're lining up for the drill season in the south coming up this summer. And then in the north will come up in the next winter time, and then further metallurgical sampling, you know, with a view to producing customer bulk samples that we'll be looking forward to sending off to potential customers that have already reached out to us over the last 12 months. So lots of activity, lots of news across multiple projects. And really for us, it's about de-risking the company and de-risking our business by having these multiple projects and seeing literally which one can we bring into production first, which will be the quickest. And then, of course, which will be the most profitable, and then further projects to follow. Next slide, thank you. In terms of board of directors, great experience, combination of business and technology, or business and geotech capability. Next slide, thank you. A detailed slide there just for investors to have a look at. That's a summary of market caps of our peer group. We're by far the lowest market cap, being, I guess, the newest entrant into the market since May. And we're looking forwards to playing catch up in our business as we progress over the next year or two with our work that I've just touched on. Next slide, thank you. So share price was a 20-cent IPO, poor timing, not our choice with the May float. Market cap, I think, sitting around $7 or $8 million on the current share price, 84 million shares on issue, very clean. Cash in the bank, just under $5 million. Next slide, thank you. So why Allup Silica? We're a very low-priced investment opportunity in the market. Why silica? It's an essential component for electronics, computers, renewable energy, etc. The renewable investment space, it's a good place to be with all the government momentum behind all these renewable technologies. It's going to be continuing for quite some time. What's driving silica prices? It's a lack of supply and a massive increase in demand driven by policy. Demands of environmental and social responsibility. It means that we've got our work cut out for us and we're up to the challenge. And purity in port, that's the solution that we're working towards. Thank you very much.
Thanks, Andrew. Thanks for your time. Quite a few questions here. Can you talk about the pricing of silica sand? Obviously, you're going to the high purity end of the scale, I suppose. And can you talk through the supply-demand dynamics? How is it priced?
Well, pricing is direct to customer, so it's very opaque. A lot of those negotiations are private and not publicly disclosed. Traditionally, a lot of the silica sand mining occurs either in private family companies or large multinationals that don't report on pricing. So I think the sort of indications that we're getting, as well as some of the other Australian emerging producers, is pick a number between 40 US a tonne and 100 US a tonne, somewhere in that vicinity. And then that's really driven by your purity as to whether you're pushing up towards the high value, high price product, or whether you're going to produce a lower quality product. Iron seems to be certainly the driver, especially in photovoltaics and some of the other potential customer demand areas. So to get below 100 ppm iron is the challenge. And that's also the opportunity where prices can be quite high. So a lot of what's happening in the silica market today is very analogous to the iron ore market 30 and 40 years ago. It was very similar for the early iron ore producers in Australia.
And just as a reminder, who dominates in this space as a global player these days?
Well, I guess the global seaborne player, at least certainly that's familiar to some Australians, is up in far north Queensland, and it's a Japanese silica mine that's been owned and operated by the Japanese for, I think, 100% for at least 20 years and previously started by Australians. And of course, that silica sand mine up at Princess Charlotte Bay on Cape York has been supplying the Japanese industry for high purity silica, which of course we buy that back in the form of various products. Our Australian high purity silica comes back in high value add products for consumers.
And where does China sit in this market?
Well, China's like just about every commodity now, depending on which commodity, 60% plus of world consumption of a raw commodity, whether it's iron ore or silica or rare earths. Rare earths, I have even a higher position. So China's 60+%. And of course, it's growth in Chinese manufacturing. The Chinese are very ahead of the curve in terms of solar panel production, which follows on quite logically from TV panel production. If you look at what's happened with our TV panels at home.
And where can you talk us through the kind of mining process and where's the export market for Allup?
Well, the mining process is beautiful. It's there's no drill and blast. It's free dig. It is sand. It is the ultimate simple mining process. Which some of us experience as children on the beach with a shovel and a bucket. I mean, it's just a bigger version of a shovel and a bucket. And then it's really just a matter of putting it through a wash plant, spirals and magnets to get that purity and that cleanliness of the product, if you like. And then export markets, well, first step is to get it to port and have the port capacity then to ship. So whilst China dominates with 60+% of world demand, there's plenty of other countries through Asia and ASEAN countries, as well as in Europe and America, of course, where they're all sensitive now to critical minerals and also understand that they need to actually revisit their manufacturing capability and have sources of supply from friendly countries like Australia.
And where are you with, I know it's very early days, offtake agreements? Are you getting a lot of interest?
I've actually been astonished as to the amount of interest. For a year and a half now, we've had door knocks being through email from various consumers, glass makers and so on, asking what purity, how many tonnes and when can we start delivering? So they're asking exactly the right questions. And we've just literally been saying, well, just give us a chance to get ourselves floated, which we've just done. We'll be deploying the capital that we've raised into feasibility study work and then answering exactly those questions for the consumers as well as for the shareholders. So we think there's a real business opportunity and many customers to talk to. So it's while China dominates, there's many other people out there in different countries also that need silica for glass manufacturing.
Yeah, I mean, there's certainly a move away from China as the sole source of supply for lots of different commodities at the moment. Andrew, that's all we have time for. Fascinating story. Love to get you back on perhaps later in the year.
I look forward to it, Tim, and thanks, ladies and gentlemen. It's been a real pleasure.
Thanks, Andrew. Okay, next up we have DigitalX, ASX code DCC. It's got a market cap of around 25 million. We have Lisa Wade, who's the CEO, with us. DigitalX is a technology and investment company which offers blockchain consulting and product development services for businesses seeking to leverage the benefits of digital technology. Lisa, nice to see you again. Over to you.
Hey, Tim, thanks. Hi, everyone. So I'm going to start on slide 6. And what I thought I'd do today is explain a little bit about DigitalX. We're flying quite under the radar. And how I would describe us is a company that operates at the intersection of finance and technology, and the space that I call the transition to Web3, which I believe is the greatest economic opportunity of our generation. Once I go through the opportunity and the market size, I'll talk about our long-term strategic objectives. I'll talk about our short-term revenue drivers. I'll go through our revenue model and our product roadmap, and then I'll talk a little bit about ESG. So firstly, I thought I'd start with the opportunity. It's a very nascent industry that we're operating in, and a lot of people don't really understand the blockchain space. So earlier in the year, Blockchain Australia had a conference, and at that conference, it was named the mainstream moment, where what we're seeing is large financial institutions are starting to pay attention to blockchain and the industry that we're operating in. And we believe that we're at the very beginning of this rise to mainstream finance. Now, that's the first tailwind that we have. The second is what we call the Web3 economy. Now, the easiest way in 10 minutes for me to describe the Web3 economy is Web 1 was when we used to just chat online and send emails. Web 2 was when we built financial rails and started shopping alone on our couches with credit cards. And Web 3 is where we meet our friends in the metaverse and pay atomically. Atomically is the asset settling at the same time as the cash part of the transaction. We go shopping in the metaverse with our friends and pay for goods and services atomically. That for me is the easiest way to describe it. And then around that are all sorts of opportunities like tokenizing data and real world assets. And a few other things that we'll go into a little bit later into the presentation. We also see an opportunity as operating to what we call the new impact standards, which is the new focus on ESG, environmental, social, and governance, I should say, frameworks, and embedding those into the culture of our corporation, because we passionately believe that companies that operate to that level will outperform other companies in the future. We're also very passionate about what we call neo-governance models, which is an opportunity within itself, which is the digitization of corporate structures and organizations, which we call DAOs, which is either decentralized automated organizations. And we'll go into a little bit more about that. That's super geeky, I get that. And then the fifth thing that we're looking at is data as an asset class. And that really is where the potential for the financial revolution, for those of us who operate as fund managers and investors, it opens up a whole new asset class and a whole new way of structuring portfolios and constructing portfolios. And it was Citigroup, not me, that called that a financial revolution. So if we go to the next slide. So just to bring home the level of that opportunity, we have some data in the universe that says that Credit Suisse estimated that $256 trillion of real world assets exist that could be tokenized. Now that number is actually higher. It's just that I can remember 256 trillion. I think UBS released a report a few weeks ago saying it was 315 trillion, in fact. So what we're seeing is a trend, and forecasts from the World Economic Forum are showing that 10% of real assets will be tokenized by 2027. And we see this as a huge opportunity, both in our funds management business and as an asset origination business. Everybody would have heard of Bitcoin. A fun fact about us is we're the only listed company in Australia to have Bitcoin on our balance sheet. And that is a very big driver of our share price. And some people might say we're the OG Bitcoin company in Australia. We like to think we're a little bit more than that. But if you had to remember one thing about us today, I think it is the number of Bitcoin on our balance sheet. So even with the forecast being, only 0.1% of the economy, what we're seeing right now, we're seeing a massive shift into that space. And we run a research document from our funds management team called the Shift List. And inside of that, we're seeing structural changes happen every single day throughout our industry that are mind-blowing. And the one that we had this week is that Swift are testing with a company called Chainlink how to put their transactions on the blockchain. Now, just consider Swift does 5 trillion transactions a day. And when we start getting that level of volume, we're really talking about a huge economic shift into what we call Web3. We've also had McDonald's starting to, take Bitcoin payments this week. Let's face it, when you can pay for a Big Mac in Bitcoin, we're nearly there, right? If we skip to the next slide, please. Great. As I've come into this role, which I started in February, one of the things I've worked on with the team is to create some long-term strategic objectives and to be really articulate about our roadmap for the future. So what we're aiming for is to be the number one in our industry across 5 main areas. That is impact, to grow long-term shareholder value, to build and to be the builders of new digital finance. We have a development team and we're very passionate about building and walking the talk. We aim to be number one in transaction volume in real world asset tokens, and we aim to be the number one investor in real world asset tokens. Next slide, please. So how does that translate into short-term revenue objectives and bringing value home for shareholders? So we've got 3 main businesses that we're integrating in the new strategy, which we'll go through that revenue model in a minute. But our short-term revenue drivers and objectives are, we own a share trading business called Sell My Shares, which at the moment is sort of flying under the radar. And what we're doing is we're growing that across two playing fields. The first one is deceased estates. For people who inherit shares and don't have brokerage accounts, we can do one-off share sales for them. And then this week we've begun testing a T0 product, which is actually a 0-time settlement for share sales, which we see is truly exciting to uplift our revenue. The second revenue driver is we've built an ETH staking node, which can earn revenue doing what we call data validation in the proof of stake world. And I don't want to get too super geeky about that. What I will say is that we have assets on our treasury that have previously returned 0, other than the movement in the price of Bitcoin and Ethereum. And now we'll earn a 5% yield from staking those assets. One of the key differentiators we have in that market is that people are starting to look at the geographic splits of validation nodes, and we're one of the only nodes in Australia. So that gives us a little bit of a competitive advantage for those who want to operate in Australia. We also own a RegTech business, which we work with the ASX, and we've built across the ASX Symphony platform called Drawbridge. And this is something that we're building to be the Web3 gateway for corporates. Our first initiative is for directors of listed companies to be able to register their shares on Drawbridge, and we basically tell them when blackout periods are and stop them from buying or selling shares in their headstock so that they don't commit insider trading. So it's like a RegTech safety net, if you like. The fourth revenue generator is the fund business. We currently have 2 funds, which is a Bitcoin fund and a crypto fund. And we have a new fund product which we're launching, which capitalizes on that trend I spoke to you about earlier, 256 trillion of real world assets. We are building a real world asset tokenization fund, which we're very excited about. We also have ventures on our balance sheet, and we own some small and interesting asset tokenization plays, and we will be expanding those venture initiatives and supporting the Australian initiative, part of what we do there is we're part of the digital finance CRC with the government. We're doing a little bit of work with them with the RBA's central bank digital currency project, and we've also got a number of other initiatives that we're building and supporting in the Australian industry, and I'm also on the board of the commercialisation committee for that. Next slide, please. Right, so this revenue model. So what we see in this transition to Web3 really is this supercharging of data as an asset class, and we see that as a real economic opportunity. So we're building our revenue model by having that as the foundation of what we do. So we have an innovation culture, we have a development team, and we innovate to create new product and to leverage that into our data validation and services. Now, an example of that, because that might sound a little bit out there, is in our real world asset tokenization fund. Our investment process is actually a data validation process. All of the investment data that creates that asset sits on data nodes or decentralized data nodes, for example, Chainlink, which has been called the Google of Web3. And those assets get validated on those data nodes. We validate the token, then we originate that token by creating a real world asset token. We invest in that token, and we do that through our funds. And we can also now Next and Beyond, which is our mantra for our strategy, transact that token into Web3. Right now, what that looks like in the transaction realm is the Sell My Shares business. I was talking about that. And we are building the business in the Now, Next and Beyond realm. So right now, we're originating, validating the data, innovating the tokens, and using the and then raising money through the funds. Now I see Tim jump on there, so I'll just skip to the next slide and finish up, which is our product roadmap. Really, I've gone through that: Sell My Shares, asset tokenization, data validation, and now I'm finished. Thanks, Tim.
We could be here a long time, Lisa, with this industry. I mean, it is a brand new industry. How do you focus your business in regards? You've got lots of different divisions there. Is it a revenue focus? Is it product driven? And how big's the team you have behind you?
Yeah, so right now our mantra is revenue, revenue, revenue. And that is driven from, we do have a product team, and we have revenue initiatives across the Sell My Shares business, which is T0, the funds business, which is, bread and butter, bringing new clients in, and then the data validation stake. And we tie that all together with this Web3 thematic. There's 18 people in the business, and we have a wonderful development team in Perth, and then we have our funds team in Sydney. So we sort of split into those two areas. And one of the things we're really doing is building these cross-functional teams and working together to really innovate, as the innovation is the foundation of what we do. So we're super focused.
And can you tell us a little bit more about the funds management business and the opportunity for investors to invest in crypto, I assume?
Yeah, absolutely. So we're a wholesale fund, and we've got two funds. We've got a Bitcoin fund and we've got a top 20 crypto fund. And really where we see the Bitcoin fund is about access for anybody who needs to access through the traditional MIS infrastructure. And then the crypto fund, we really pride ourselves on being a safe pair of hands. Not all crypto is created equal. And what our team does is they do extensive equity style research into this new and nascent industry. And we really invest in the opportunities that we see emerging. And what we pride ourselves on is finding, tokens inside the top 100 that we believe will move into the top 20, and Chainlink is a great example of that. What we're really doing is the work, and it's a highly volatile investment space. I've never seen anything like it. And what we're doing is providing a quality of research for people who want to invest.
And do you think it'll be regulation? I know the SEC in the States is talking about regulating the industry. Do you think that will help it become mainstream?
Oh, yeah. Look, we participate in the regulatory conversation in Australia. Regulation to us is hugely important. We believe it's very necessary because there is a lot of divergence in the industry, and, there's just a very big divergence of actors in the industry, and we believe it needs to be regulated, and we welcome and are excited about regulation. And obviously it's a huge topic globally. We did a panel for Bloomberg during the week, and I listened to Steve Vallis explain the global regulatory landscape, and I broke it down into Europe has very detailed regulation coming. China's banning everything. The rest of Asia is a free-for-all. The US is suing everybody, and Australia's writing a report. And so Australia's contribution is a token taxonomy, which I think is hugely important. And I was at a conference a couple of weeks ago in Europe, and I asked the panel what they thought was the most important thing in regulation. And it was across the board a token taxonomy. So I'm actually really proud of Australia and our contribution to the global regulatory conversation.
Yeah, I'm fascinated by the industry, Lisa. I'd love to get more content from yourself and your team just to share with our audience. I think a lot of people are ignorant about it. A lot of people are scared about it because of the volatility, but it's a critical pathway moving forward, I think, that education and keeping people informed.
Absolutely. And if I was to leave one thing in the space, it really is that when you select the right crypto opportunities, what you're investing in is building the new financial rails of the future. And there is a way to operate in this space. Yes, it's volatile, but if you can take a long-term view, there are great investment opportunities.
Thanks, Lisa. I'll follow up. I'd love to get some content from you. Thanks for your time. Have a nice weekend.
Bye-bye.
Okay, next up we have Prime Financial Group, ASX code PFG, market cap of around $43 million. It's got a one-year return of up 50%. We have with us Simon Matter, who's both the MD and CEO. The company provides accounting, wealth management, and business and capital advisory services. Simon, I can see you moving all over the place there. Over to you. Thank you.
Thanks a lot, Tim. Sorry about that. We thought we'd make it a bit exciting to get started. Okay, so here we go. Thanks everyone for attending. I'll jump straight into the presentation. I'm sure everyone would like to get to lunch for those on the Eastern Seaboard. So Prime Financial Group, if we could just go to the first slide, please. So let's start with the highlights of 2022. We had a great year. The team performed exceptionally well, and that was represented by an increase in our underlying EBITDA of 15% to 7.8 million. We also had revenue growth of about 18%, which in fact was actually our best revenue growth we've had for a number of years. As really starting to show that our strategy for growth is working well. So up 18%, 26.3 million in total revenue for FY22. EPS was up 14%. It would have been up slightly higher, probably closer to 30%, if it hadn't been for us subletting our office space here in Melbourne that we didn't need anymore, or half of it at least. We've also had an increase in our dividend, which is up 57% to 1.1 cents per share. Our margin was maintained at 30%. That's grown from 19% to 30% over the last 4 years. And we've also been able to substantially reduce our debt to a fairly modest 0.7 times underlying EBITDA at 5.2 million. That was down 26% for the year. Our operating cash flow remained very strong, up 11% to 6.1 million. So overall, the scorecard looked pretty strong, and the team did a great result. Next slide, please. Some other important information in terms of our growth prospects and how we've been developing the business. The team actually grew by 30% over the last 12 months. Now got 130 team members, which I'll talk about in a little bit more detail in a moment. We've also got an equal focus now on organic and inorganic initiatives. In fact, we actually completed a transaction earlier this week, our first transaction from an acquisition point of view in the last 4 years. As I mentioned before, our dividends are up 57% in FY22, but importantly, we're also forecasting that they'll increase by a further 36% in FY23. We have a buyback in place. We've currently spent about $900,000 buying back our own shares. That will continue on into the future. Next slide, please. So I thought it'd be worthwhile just touching on the business's performance over the last 5 years. We repositioned the business in 2018, and what you can see here, when you look at each one of these key metrics, be it underlying EBITDA or reported profit after tax, there's been a substantial improvement and a consistent trajectory in terms of our increase. You've seen underlying EBITDA move from 3.7 million up to 7.7 million in 2022 from 2018. You see the reported after-tax profit go from 1.3 million to 3.8 million. EPS has gone from 0.77 cents per share to 1.93 cents in 2022. And our dividends after dipping in 2018 have consistently grown to be 1.1, moving to 1.5 cents per share in 2023. The share price there, as at 30 June, at the end of each one of those financial years, is highlighted. It bottomed out at 6.5 cents, moving to 17 cents on 30 June 22. Today, it's around about 22, 23 cents as we stand. So overall, what you're seeing here is the strategy we put in place in terms of one connected, consistent advisory and capital firm is really starting to play out in a positive manner. Next slide, please. So a little bit more detail on our firm. So we are an advisory and capital group. We do pride ourselves on being able to deliver multiple services to our clients. The clients sit in the middle and we surround them with services including accounting, wealth, corporate advisory, and also SMSF admin. We also look after about $1.1 billion of clients' funds at the moment, and the business has been around for about 25 years. Our core offices are in Melbourne, Sydney, and Brisbane, and our purpose is all around empowering our clients to achieve their aspirations, but also our team as well. Our team is a super key focus for us. And as I said before, we have 130 team members that are split across those locations, but we do operate a very flexible staffing structure, which allows people to operate from pretty much wherever they need to do their job well. We have a centralised services structure, which is substantially based in Melbourne, but we also have team members in the Philippines. Centralised for a key reason. We don't want to replicate costs throughout the business in different locations. So that's allowing us to get leverage, and it's the reason why we've been consistently improving our operating margin. Next slide, please. So how are we growing? Probably the most important point here, and there's a fairly important statement that starts this. In FY22, we had revenue of $26 million. Over the next 3 years, through organic and inorganic activity, we want to grow revenue to $50 million. We're doing this in 4 ways. One, organically. When I show you the service line revenue from our 4 key service lines, you'll see that they're all growing organically, and they grow organically through 2 key areas. One is our partners going out and securing new clients, and 2, our existing clients being referred into other divisions where they need additional services. The other way we're growing is by attracting new team members, new professionals, accountants and advisors that have their own existing client base where they want to be part of a bigger firm that can offer more services to their clients and where they can become an owner in the business as well. So that's another key part. That's number 2. Number 3 is new service lines. As I said before, we have 4 service lines, but we consistently deliver and build new services that are relevant to our clients. In the last 5 years, the 2 new service lines that we've put in place have been corporate advisory and also SMSF admin. And those 2 service lines now account for over $7 million of the $26 million of revenue we had in FY22. We haven't undertaken the 4th point for the last 4 years. We've been focused on organic growth and new services, but we are now in a position to acquire other businesses that are complementary and where we can add value to that particular business. And I'll talk a little bit more about Intello in a moment, which is the acquisition we completed at the start of this week. Next slide, please. Okay, so Intello. So on the 4th of October, we acquired 100% of Intello. Intello is a B2B SMSF administration business, and that will fit squarely within our SMSF service line. The business that we have acquired has around about $3 million of annual revenue. It will contribute about $900,000 plus of EBITDA to our firm. It is highly EPS accretive. It is a cash transaction, $4.6 million with 70% paid up front and 30% in 12 months. This is all being done it's being funded through operating cash flow, but also through an additional facility we have in place with Westpac, which I'll speak about in a moment. But it's also being done in the context that we don't want our debt to EBITDA to be more than 0.5 to 1 times, which is where it's currently sitting at the moment. So for context, when we talk about the SMSF division, in FY22, it made up 10% of our revenue. With this transaction, which has a fantastic team, which we're really encouraged that are joining us, that revenue will move to being 20% of group revenue into FY23 and beyond. Next slide, please. As I mentioned before, one of our 4 strategies is acquisitions, and that is something that we've been very modest in approaching in the last 4 years, but now it'll feature as part of what we're doing. So in order to fund that, we have put an additional facility for acquisitions in place with our banker of 15 plus years being Westpac. That's for an additional $10 million. Clearly, $4.6 million of that has been spent on this first transaction. The limit that we have in place now with Westpac is $20.6 million. And as I said, all transactions will be looked at through the lens of not having our debt be more than 0.5 to 1 times underlying EBITDA, and that will be measured on an annual basis. Next slide, please. So a little bit of detail about our capital structure and some of our peers. So our market cap, as Tim said, is about $45 million. We're currently trading at about 10 times 2022 EPS. We've got a 5.5% fully franked dividend, and I'll talk a little bit more about the shape of our dividends into the future, as I've already touched on. Importantly, we are a business that takes ownership by staff as a key metric. Something that's really important that we all act as business owners so we get the right return for all shareholders. So 44% of our firm is owned by key management and staff, and team members, once they've been with us for 12 months, start earning the opportunity for equity on the basis that we all perform together and deliver growth at share price level and also at the earnings level. Our key comparable companies are listed there. Really, Kelly Partners is the business that is most closely aligned to what we do, but we also have probably more diversity in what we do because we're across accounting, wealth, corporate advisory, and SMSF. Next slide, please. So a little bit more detail here. I've touched on all of this, so I'll only spend a second here, but $26.2 million of revenue, contracts with customers, EBITDA of $7.8 million, the margin of 30%, and our final dividend, which was actually just paid on the 30th of September, of 0.6, but you'll see the interim for 23 go to 0.7, and you'll also see the final for 23 go to 0.8. Next slide, please. So here's a little bit more detail on the 4 various service lines that make up that $26.2 million. So our accounting operations are at $10.4 million for FY22. You see that that's grown by about $500,000. You also see the wealth management business, after coming down for a period of time and being realigned, is now back in growth mode, up $900,000 between 21 and 22. Capital and corporate advisory, the second newest service that we've got, has had a consistent growth path. That will continue. And SMSF, all of that is organic growth there to 2.8 million. That will continue organically, but also through the acquisition completed earlier this week. So as a reminder, we'll grow the firm by continuing to grow organically in these 4 service lines, but also through new revenue contributors and also through acquisitions as well. Next slide, please. A little bit more detail here about our cost management. I mentioned the centralised services structure that we've got where we keep costs down. What you'll see there between FY19 and FY22, we're now pretty much at the same cost base, but obviously with substantially more revenue. So we've been able to manage the business efficiently, and that's part of the reason why the operating margin has improved, as has our underlying EBITDA, which you can see below there has moved from 5.2 million in FY19 to 7.8 million in FY22. Next slide, please. Margins I've mentioned, so nothing more there. Our debt peaked at 9.8 million, being 1.8 times underlying EBITDA. Now back down to 0.7. As I said, it will remain in that range. Our operating cash flow is very strong. In fact, it's about 4 times higher than what it was in FY19, and that has allowed us to equally do a few different things. 1, increase our dividends. 2, buy back our shares. 3, undertake acquisitions as well. Next slide, please. So dividends here, this is a really encouraging shape. We pay out about 40 to 60% of our maintainable earnings. We paid out 52% in FY22, but we are confident that with that strong cash flow I just mentioned, we can continue with that trajectory into FY23. And the dividends are an important part of making sure our shareholders are getting the right return. Next slide, please. Balance sheet, I've touched on this, so I'm not going to really speak to this in any more detail. We might skip through to the next slide. Outlook, the important thing. So this outlook was produced at the time when we reported our results in August. So this hasn't changed subsequent to the acquisition. We'll update our outlook at our AGM, which is at the tail end of November. But we are looking forward to continued growth in FY23. Revenue will grow at 15% plus. We'll see an increase in our underlying EBITDA of at least 5 to 10%. EPS will grow by at least 15%. We'll continue actively exploring new service lines, new people joining us with existing client bases and acquisitions. The dividends will increase by a further 36% in FY23. The debt will remain as mentioned. The buyback will continue. And most importantly, we've got a great team and we want to encourage them to grow and become owners in our business. We think that is strongly correlated to developing a strong business for the future. That's the prime story. That's where we're at the moment, Tim, in terms of outlook. And look forward to taking any questions you may have.
Thanks, Simon. Quite a few questions here. Now, while you're not strictly a financial advice business and you've got those other divisions and verticals, if you like, you've got really attractive margins, which is potentially surprising. Where are those margins coming from?
Yeah, so across the business, it is 30%. And what you see is that, as an example, in our accounting division, we've got about a 35% operating margin. In the wealth division, it's approximately 27 to 28%. The SMSF division, because it's kind of the baby and the newest division, it took some time to become, to generate a positive margin. Last year, it was around about 20%. And our corporate advisory division is the same. It's anywhere between 30 and 35% on an ongoing basis. So it's pretty well split across the business, but encouragingly, we've got 80% of our revenue is recurring in nature. So that allows us to make prudent decisions about growth, and it allows us to be considered in how we go about, improving the business from a long-term perspective.
And you've mentioned future M&A. What sort of segments within the financial services industry are you looking at?
Yeah, so we encourage all of the MDs of our various sort of divisions to think about acquisitions, but not to just do it on the basis of what it might be good for their particular division. We've pushed really hard for this mentality of one connected firm and doing multiple things for our clients. So when we look at a transaction, it's not just about whether or not we could operate that business, whether it's complementary, but in fact, what it could do for our other divisions. So there's a few different lenses that we look at it through. But we encourage everyone to look at it, and then the board makes an informed decision based on what fits most into the strategy.
And for a potential investor that's kind of looking at your businesses to become a shareholder, you've kind of increased debt and you've been undertaking a buyback, and the cash in the bank is quite low, but you're talking about paying dividends. How does a potential investor kind of reconcile the balance sheet?
Yeah, look, I think with a business like us, we've obviously got strong cash flow, so it does afford us some choice. We're not too lumpy in terms of how we generate our earnings. So that allows us to think about things on an ongoing basis. So we didn't do transactions for 4 years because we were focused on the organic growth, centralising our structures and creating the right margins. We've done a transaction now. If you suggest I was going to do transactions every 6 months, that wouldn't be correct. This is a pretty material transaction for us. But over the next year or two, we'll look at another transaction, but on the basis of keeping our debt within that range of 0.5 to 1 times. We balance the buyback based on the share price and what we think is fair value, but dividends are a priority in terms of what we think about for total shareholder return as well. So it's a constantly evolving consideration, and one that we tinker with as we go through, but we keep consistent in core philosophy around debt and dividends.
And there's a question here in regards to your share count has increased from 170 million to around in 18 to around 200 million in 2022. Where's that come from?
So part of that would have been acquisitions that were undertaken in the prior period, where there's been shares that have been issued because team members or businesses that we've acquired are now ongoing team members. That's different to the transaction that took place earlier this week. That's a cash transaction. The owners are involved with the business for the next 12 months, so there's not that ongoing requirement beyond that. So the share issue goes up purely because of two key things: acquisitions where shares have been issued, but also under performance rights plans as well, where staff get shares if there has been an increase in our earnings and our share price, and each have to increase. The share price has to increase 20% per annum, and the earnings have to increase at least 8% compound each year as well. So they're the two mechanisms at which we'll see the share price number of shares increase. But obviously we've got a buyback on, and that's why it's starting to come down again.
Thanks, Simon. And just to finish up, the economy is a bit patchy at the moment. Do you see that impacting your businesses at all?
Yeah, look, I think the benefit we've got is through the diversity of those various service lines. I think what we've found over the course of the last 3 years through the pandemic is just how resilient our business is, and that diversification has been helpful. And I think there's just a constant need for all of our clients, whether they're businesses or corporates or individuals investing their wealth. They need advice. So yes, you'll see things that move around from time to time, but even through last year, which was touched on by the pandemic, we grew our revenue by 18%. So I think the recurring income and the diversity gives us a good position, but things will move around from time to time, but we're pretty confident about our future.
Simon, thanks for your time. Thanks for the update. Have a nice weekend. We'll catch up probably next year.
Great. Thanks, Tim.
Okay, everyone, that's all we have time for. Enjoy your weekend. It's going to be wet in Sydney. Thanks for your time. See you next week.